credit is not a mystery. Many people misunderstand how credit works and really don't have any idea as to how it's determined that they are able to borrow money. They feel it's like the Wizard of Oz who's behind a big gray curtain and is deciding are the companies going to lend them money and not understanding why they will or why they won't. But credit is not a mystery. It's a simple mathematical equation. FICO, which is your FICO score, is dictated from Fair Isaac Corporation, along with Experian, TransUnion, and Equifax. These are the three major credit bureaus who are used by lenders all over the nation to determine if they're going to lend you money and how much money they're going to lend you, and then the terms and conditions that they want to lay out for you. Interest rate, closing costs, parameters, how long they're going to lend you money. Are they going to lend you money for 2 years, 3 years, 4 years on a car? Are they going to lend you 30 years on a home? So your credit is so important. And in America, in our country, you cannot do anything without credit. So hopefully I'll be able to take away some of the mystery that's involved in credit. Credit is not a mystery. It's a mathematical equation. And the first part of that mathematical equation has to do with payment history. How does somebody pay their bills? If companies want to lend you money, they want to know how your patterns have been in paying your previous existing debt. So they look very carefully at how you paid your debt, your payment history. And they're going to look at over 7 years. By law, items can stay on your credit profile for 7 years. And they're going to look to see if you've been on time and consistent. And that's a third, basically, well, a little more than a third of your credit profile, of your credit score. Now, when they're looking at payment history, just keep in mind that the most important aspect of how you pay your bills is how you've been doing recently. We cannot change the past. If you've had problems in the past, haven't paid on time, you've got to move on and understand this, that an older late payment has a lot less weight than something that is fresh. And each year it's a different algorithm. For example, if you were late in the last 12 months, it'll drop your score considerably. A late payment that was 3-4 years ago is going to have less impact on your score because it's not as recent. It's like a wound. When you get a wound, it hurts, it burns. When sweat gets on it, it's going to hurt, etc. And as it gets a little bit more down the road, it begins to scab and eventually it becomes a scar. Still a reminder of that wound from 6 months ago or a year ago, but definitely doesn't hurt. It's simply a reminder. Same thing with your credit profile. Something that's new is going to have a bigger impact. It's going to hurt more. Something that's, about a year old, 2 years old is going to have less impact. It's still going to impact your score. Something that's 3-4 years old, is going to be a scar, but depending upon where your credit is, it'll impact you a lot less. So be encouraged. And moving forward, just, pay your bills on time. Make sure that you auto pay any credit cards you can, or car payments or mortgage notes. And also, I think a great thing to instill is Google Calendar. Put it in for your credit cards or whatever so you never become late. Having a 30-day late will knock you out completely from purchasing a home, car, or obtaining credit. Second part of the algorithm is utilization. How you utilize the cards that are given to you. Now, a lot of people feel when they get credit cards, this is great. I've got money. I can do what I want. I've got freedom. I can go and purchase whatever I need. Lenders look at it a little bit differently. They want to know that you're responsible and that you don't go haywire when you're given money. So if somebody uses, let's say you get a $3,000 credit limit from a company, an appliance store, and they give you a credit card, it's a revolving credit card, and you use $2,500. That's a really high utilization rate and will impact your score because you're not leaving room on your credit card. When you borrow less, let's say that same $3,000, you borrow $300. You're using your card about 10%. You're leaving a lot of money on there. And at the same time, you show you're not desperate to use credit. And this is all in that mythical algorithm of the credit score. Utilization is going to be a huge player in where your score ends up. And FICO, the scoring model, is going to look at someone who uses their credit effectively and doesn't overuse it. Now, what a lot of people seem to think is they can use their cards, say 75% and then pay it off at the end of the month and all is good. Well, a couple of schools of thought. You want to use your cards as judiciously as possible, because when the companies report to the bureaus, that is part of the algorithm. And also, based on the date that it reports, you might think you're paying off that card and you didn't pay it off in time for when it reports. So it can drastically impact your score. What I tell everybody is, when you're trying to get your score as high as possible, use your credit cards as little as possible. Do not let them sit. You can't not use your card. You need to consistently use your card. If you don't use your card for 6 months, they will close it, and that's a danger. You never want a closed card. So less is more. It's a fact that the person who has between a 760 and an 850 score, on average, uses their credit cards, revolving credit cards, 7%. Instill that. Use it judiciously. First of all, you're not going to get into debt. You're not going to be paying high interest rates back as well. And basically, you're going to be paying cash. But utilize these cards. It's very, very important. And, if something does happen, you have them for reserve. But don't try to use them to pay things you should be paying cash. Use fiscal responsibility. So utilization, debt level is important. Simply what it is: you have a credit limit, which say is $1,000. That's your credit limit, and your debt, let's say it's $200, you're now using it 20%. $500, 50%. Less is more. And when lenders look at you, when you borrow less money, they're saying to themselves, this person knows how to use credit. And in turn, we're going to want to lend them money, because we know when we lend them money, historically, they've showed, I am going to pay my bills on time. Those are the two biggest factors. The third one, it's about 15%, and it's the length of your credit history. Most people begin getting credit somewhere in the ages of 18 through 22. And the way it works is your history begins when you start getting credit. So, where does adding new credit come into this, and how can it impact your score? Well, when you add new credit, what you do is you lower your average age of all your accounts, your summary age. Let me give you an example. Let's say you have 3 credit cards that total up to 24 months. You have 3 of them. One was 12 months, the other 2 were 6 months, but 3 of them totaled to 24 months. Now, you would take 24 divided by 3. That means your average age is 8 months. Okay? Now, if you were to add a couple of cards, let's say you add just 2 cards, brand new cards, you add them today, and you're happy. You got $500 limit and $1,000 limit. Now you have 5 cards for 26 months. Okay, so you divide 26 months divided by 5. It's roughly 5 months and change. So you've lowered your average age of your accounts, which in turn will, guess what? Lower your score. So you want to add credit in increments, and you don't want to over add. Now, if you're trying to build your credit, you can't take the option of doing it all at once. Depends on your current situation. But just use responsibility in adding credit, because age is going to affect you in a negative way, but it can also affect you in a positive way. As you've had credit for a while, you begin to get stronger, you're established, and your score is just going to be as robust as possible. So the average age of your credit cards is important. Never close an account unnecessarily. Obviously, sometimes you have to refinance your home or refinance your car, or you pay off your car and you want to buy another one. Totally understandable. But you do not want to close credit cards unnecessarily. It just is not going to help your FICO score. 10% of your credit score is now going to be the mix of your credit. And this is where it gets a little bit misunderstood. A lot of people think, hey, when I get a car loan, when I get a mortgage loan, this is going to help my score tremendously. Well, don't mean to be the bearer of bad news, but installment loans do not have as much impact as revolving credit. Why? Well, it's a fixed duration. When someone gives you an installment loan, it can be a year, it can be up to 30 years, but it's a fixed duration. So based on your credit score, for example, you go into a car company and your score is at a certain level and they say, you know what, we're only going to lend you for 3 years versus 6. That's based on your FICO score. But the installment loan, the reason it affects your score less is it's fixed and it just has less impact on your score. They're great to have. Don't get me wrong, but if you're trying to get your credit score up and you're trying to move the needle on your FICO score, the very best way is with revolving credit. Now, revolving credit can spike your score, but it's a higher risk and it can be more volatile. Let me shed some light on that. So, why does the FICO scoring model take into account revolving debt and why does it affect your score more dramatically? Well, it can change. For example, you open a credit card and it's $500. You pay it on time for 6 months, and guess what? You get a notification. We have now increased your credit limit to $1,000 and you're happy. Guess what? You can buy the new laptop that you want to buy. So, before you were paying on time and you were about, say, 20, 30%, you're using your cards at a decent level. But now you go apply another $600. You get all the warranties on it and the protections so nothing happens to the laptop in case the kid spills your coffee on it. And now you're at 90% utilization. So it changes you more dramatically. However, if you're smart and you use it judiciously, let's say, for example, you were using on the $500 credit card, you were using it $100. You're at 20%. Well, now you have what? $1,000 limit, and now you're at 10% usage. So you can maneuver it, you can massage it, so to speak, to work in your advantage. Be smart with your, how you use the mix of credit. Installment loans are great, don't get me wrong, but revolving credit is going to be the one that's going to put the spike in your score in the quickest time frame possible. And 10% of your score is inquiries. Why do inquiries affect your score at all? Well, the way lenders look at it, and Fair Isaac looks at it, is that when someone's inquiring for credit, there is always the danger that they're overextended in their financial situation. So when a lender sees 3, 4, 5 inquiries, they know that maybe they're not making enough money to handle all their needs and they're going to use credit to get them through. That's why inquiries do impact your score. And that's why when you go for a home loan, when you're applying for a home loan, they'll ask you to write a letter of explanation as to why you applied for credit. Did you obtain credit? Because the lender wants to make sure you didn't get a new car loan or you didn't buy a mini bike or anything that would affect your credit profile. So inquiries are very important. You want to keep your inquiries down. Now, how do they impact your score? Well, they stay in your credit for 2 years, 24 months. The biggest impact is the first 120 days. Does the others impact the score? Yes, they do, but it's on a lesser scale as well. But the first 120 days impact your score the most. And, you want to make sure you do your inquiries judiciously. And one note on that, if you're applying for a mortgage loan, and let's say you are shopping around to different banks, you will only be impacted by that mortgage pull on the first pull. So you do have the right to shop. It's a 14 to 30 day window. The safest spot is 14 days, just to make sure you're not going to have an impact on your score. But 14 to 30 days is generally, where it's in the algorithm. Now, what that means is if you went to one bank and they pulled your credit initially, your score would drop from that initial credit pull. The next bank you go to or lender you go to, it's not going to impact your score. Yes, they're going to pull your credit and it's going to show up as an inquiry, but it's not going to impact your score. And you can have that for up to, like I said, 14 to 30 days. And you can have your credit pulled 3, 4, 5, 6 times, and it won't impact your score. So, Fair Isaac and Experian TransUnion and Equifax know that not everybody's going to hit it off with that certain lender, or they're going to shop around. So it's called right to shop. So that's the myth of the multiple mortgage pulls. And just rest assured, you do have that small window. So in recap, how does it work? You have payment history, you have your utilization, your length of credit, you have the mix of credit, and then you have utilization. All of these are important, and all of these, are going to dictate where your score is going to be. And one other thing I would like to add, if you do have collections or you do have charge-offs, can you pay these off and raise your credit score? Well, unfortunately, you just can't buy your credit. Once you've been in violation of your contract, terms of your contract, it reports as being something that was either written off and then turns to collection. And Equifax, Experian, TransUnion, and Fair Isaac in conjunction do not want you to go back, pay 2 years later, 3 years later, and think it's all going to magically go away. It'll show as paid in full. It might even be zeroed out on your slate. However, they will not delete it unless steps are taken to get that item deleted from someone who has that skill set. So credit is not a mystery. It's a simple mathematical equation. And I pray that, moving forward, you'll have plenty of credit health and you'll be able to purchase the home or car of your dreams.